is the situation with Canada's housing and affordability. Obviously, it's a crisis. You're realtors, you know what's going on in the market. But just to give you some numbers, we are looking at a big shortage. So pretty much there's a housing supply shortage. And of what's being built and what's planned in the pipeline, we're still going to be short about 3.5 million homes. Okay. This is, a huge gap, and CMHC, government, everyone's trying to figure out how do we bridge this gap and kind of make the situation better. What does it mean, though? Pretty much it means that as you have all this supply shortage, we're actually seeing a lot of growth, and they have strong economic growth in specific areas. And this is kind of amplifying the problem of the housing shortage. So specifically in Alberta and Quebec, we're seeing that everyone is very optimistic about the real estate market. Household incomes are strong, demographics are strong. And these are areas that CMHC has said we are focusing on these specific areas. And these areas have the most problem with the housing supply because they have strong economic factors behind them. So for the latest estimate from StatsCan actually indicated that the province of Alberta had the fastest demographic growth in Canada, being about 4%. This is actually the highest net interprovincial migration growth rate that they've ever seen by any province. So huge growth in Alberta, and kind of why is that the case? We're going to go into those details as well, but just wanted to point out we have a housing problem. It's specifically in an area like Alberta. Because affordability, this whole crisis has, the shortage and affordability have all impacted the rent rates, right? And what has kind of happened? Why is there so much growth in demand? Over the last decade, home prices have grown 3 to 4 times faster than household incomes. So house ownership is out of reach for many, many people. The interest rates haven't helped. So with that, mortgages have become less affordable. They seek rental housing, which means we have a big demand for this multifamily type of unit. Also, as affordability declines, the demand continues to increase, especially in affordable markets such as Alberta and Edmonton. And this is why we see a really good environment for these types of investors. So just to give you perspective, when we're talking affordability, out of your total monthly mortgage, in an area like Edmonton, you're looking at about 22 to 25% of your total household income being a mortgage payment. In Calgary, prices are slightly higher there, so you're looking at about 40% of your income going towards your mortgage. But Toronto, 80% of the average mortgage accounts for the monthly income that you have. So you can see why it's a lot more affordable out there and why this type of opportunity exists. So Edmonton, if we can go into the details of why Edmonton specifically. Based on the latest Realtors Association of Edmonton remarks, they've said that the demand for residential property shows no signs of slowing down. So 2024 was a phenomenal year for Edmonton. And with the decreases of all the interest rates we're expecting, everyone expects that these conditions are going to be amplified in the market. Intensifying competition, which means higher prices, a lot more competition from the rental market. But everyone is seeing that the prices are continuing to go up, and there's continued confidence in this market. Again, lower interest rates, they think it's just going to be more fuel to the fire, and we're going to see some more upward pressure on home prices. Overall, 2025, they're saying it's going to be shaping up to be another dynamic year for Edmonton. So not only is there an opportunity strong on the rental side for a program like this, you're also in a market that is very active, growing significantly, and has the opportunities for appreciation as well. So about the economy, we're actually seeing that the population continues to grow. Over the last 5 years, they've seen an average about 12.6% growth, and it's going to continue to grow. The nice thing is it's also a young demographic. So they actually have one of Canada's youngest populations, which means there's a demand for housing. Also, a lot more young professionals that are going out there seeking accommodations for their family. And there's just longevity in terms of the workforce of, who's there and looking for jobs and their a level of active participation in the economy. The government and corporate investment, lots of major investments that they do, particularly in infrastructure, lots of public transit network and healthcare facilities getting improved and added in. And overall, it's a very business-friendly policy environment with low tax rates. So it's actually called a magnet for corporations and individuals because their tax rates is only at 5%. So they don't have a provincial sales tax, PST, so it keeps things nice and low. So it's very attractive for consumers as well as businesses to migrate here. So all of us know the backbone really of Edmonton and Alberta is driven by oil and gas. So the nice thing is there's a consistent level of stability that's created, which means, there's lots of jobs that are created, consistency, employment, lots of consistent spending, as well as a continued demand for real estate as well. High employment rates because of the industry here. We also have lots of developed infrastructure that's resulted. So logistics and supply chain hubs, very, very strong as a result. Also, a lot of ancillary industries are all enhancing property values and investor confidence. They're all joining in the market and taking advantage of these benefits. Tax advantage. So because of the oil royalties, we actually are able to have in Alberta very low provincial taxes, and it makes it attractive, as I mentioned. Future growth, they actually invest a lot of money in energy transition, sustainable initiatives. So aside from just oil and gas, on the energy perspective, they're trying to grow and develop and be forward thinking. Aside from all that, tech is booming. So the city saw over 53% increase in tech employment over the 5 years, as per a study by CBRE of 50 different cities. So this is huge. It's an area of focus. A lot of companies are already there. So as you see on the right, a lot of big tech titans are there, and they continue to migrate, or they're closing locations in different areas of Canada and making them bigger, actually, in the Alberta space. The reasons why, we have lots of competitive advantages there. Talent is affordable. So you're getting really high quality tech talent at very competitive costs. We also see the operational costs being much, much lower. So to operate a 500 person tech company, you're looking at around $10 million USD cheaper compared to other North American average of cities. The institutions are big out there for a lot of AI learning. So University of Alberta is known for its AI research and its programs. They have a lot of affiliations with local organizations, even on Ontario here. But they are focusing on, forward thinking again, AI research. And that's going to continue to fuel this area of the economy. And Class A office space, you're getting nice new Class A office space for very low rent rates, which again add to low operational expenses for all of these companies. So all of these making it very attractive for the tech scene. This was actually announced probably about 2 months ago, but the largest AI data center in the world is actually supposed to be built in Alberta. So this is very exciting for the province. The price tag associated with this is about $70 billion. And outside of that, we're expecting about $100 billion of potential investments, just as a sidebar because of this coming to the space. So this is an O'Leary Ventures initiative, and they say beyond jobs and financial benefits, it promises to establish Alberta and Canada as world leaders and a center of excellence in the emerging industry. So everything focused towards growth, clean energy, AI learning, and it's really the perfect environment for these AI data centers due to the low costs, also due to the natural resources. They need a lot of energy to fuel these AI data centers, and they're abundant in that in Alberta. And also the climate. So being in the cold also actually helps with these data centers. So it's the perfect location, and we're going to see continued AI growth in addition to this big addition to Alberta in the next few years. Beyond energy, we also see a variety of other companies, all different walks of life coming here and growing. Amazon, for example, they have their fulfillment center in Atchison, just outside of Edmonton. They opened recently in 2023. That is their biggest hub, actually, for all of the robotics fulfillment. That's their fourth location, actually. So they continue to establish more and more locations around Edmonton. You're seeing the Home Depots, the Bricks, pretty much anything from, bricks and mortar to food venues that are all expanding and growing significantly in the Edmonton space for all these reasons. From a real estate perspective, we're seeing that the growth is all there. All the good, nice things that we like to see. The growth, we saw an approximate 11.8% year-over-year increase as of September of last year. We're seeing that the affordability is around, average home, $440,000. Very nice, low, affordable, and that's why these projects make sense in this type of location. Compared to Toronto, for example, at about $900,000, and Vancouver averages about 1.2. We're seeing the housing prices go up. We're seeing the rental rates go up. So you're seeing double-digit returns for the rental growth for all different categories. A lot in the low-rise category, but everything pretty much has been going up. And on the flip side, vacancy rates keep going down. So it's actually declined from an average of about 4.3 originally, down to below 2.4%. And we're seeing that vacancy rates are continuing to go down because of these economic factors in the demand. Real estate savings. So what are some of these savings that you're going to see? And they're fantastic. You're going to see lower property taxes, which means you're going to have overall lower operating expenses. There's no development levies, no land transfer tax, and a lot fewer barriers to entry for development. So a lot of less hurdles to get things approved, to get things built. And these all are reasons why they can keep the pricing more affordable as well. The costs of construction are quicker, they're more predictable. And that's again why prices remain low, and you can have the higher operating costs, which means higher returns because you have lower operating costs. So overall, always net incomes are going to be consistently higher in this market. Edmonton, the landlord policies are just something we're so not used to, and they're quite beautiful over there. Pretty much anything goes in terms of no rent control. You have a very fast eviction process, so people can get evicted in the space. I've heard 14 days. They're not paying rent, you can get them out. Completely different than what we're used to here. Very efficient. You can also have a damage deposit. So instead of last month's rent, you can actually have it as damage deposit. So that's nice to have in your pocket. You also have greater lease flexibility. So you can specifically set your lease terms and you're not obligated to renew. So here we automatically go month to month. You don't have to do that in Alberta. You can choose if you want to get your tenant out or not. We also didn't see any rent freezes during the emergency. So during COVID, there was no, rent delays and, breaks for any of the tenants during this period. There's also the ability to end the tenancy without cause. As long as you're out of your fixed term, you can end it for whatever reason you want. Maintenance obligations are a lot simpler. So in terms of the upkeep, of course, you're still going to be responsible for that, but the rules around it are a lot less onerous on the landlords. And there's also fair utility rules. So here in Ontario, you have to stipulate up front what utilities are included and what's not. In Alberta, it's known that you just cover your utilities. So even if you didn't exclude or include certain utilities in your original lease agreement, the tenants are always responsible for paying it. So what do these things all mean? It all means that you have predictability with your rents, you have control over your properties, you have lower operating costs, higher returns, higher net income. It also breeds, with these rules, a better environment for tenants. So when you have a tenant that knows that they can get kicked out if they're delinquent, that they shouldn't cause any property damage because they're going to be on the hook for it, you're going to get a better tenant pool out there as well. So just to sum it up, we have much lower cost to entry, houses are affordable, you have very high rental yields because the incomes there are actually much higher than even in Ontario. So you're getting good rents, you're getting a pro-growth policy type of environment. So all these city incentives are towards growth, eco-friendly and affordable housing initiatives. We are seeing economic growth, so continued growth, stability, and that will also help with the rental demand. And there's less market saturation. So because there's such a demand there, not enough housing, you are seeing lower vacancy risks. So median renter income by city, as you see there, you see Edmonton is pretty much right on par with like Vancouver. It's one of the top in terms of in Canada. And why is this important? It's important because when we're looking at even the MLI criteria, having to hit your affordable numbers, affordable rent is very high there. So in order to hit your affordable rent criteria, per month, you're looking at $1,665 is your benchmark. And you just make sure that your affordable units are below that. Because it's so high, that means that your market rents are pretty much going to be under that price point without having to take any sort of a discount. So that means you can still hit your affordable criteria without discounting your rent just to hit your criteria. Whereas in Toronto, for example, our prices are already inflated. They're very high. Median renter income is much lower. So I think the monthly affordable rent criteria is about $1,215. So you can imagine if the prices are high, the average rent's $1,215. Clearly, you're going to have to take a big discount on rent in order to qualify for the program and to make the numbers work. So I'm going to pass it over to Meet. He's going to talk about the CMHC MLI program specifically.
Thank you so much, Linda. Thank you so much, guys, for joining in our session. Now you already know, right, why Edmonton is one of the best suited cities for CMHC MLI program. I'm just going to dive in deep of what this CMHC MLI program is all about, right? Like what it offers you and how you guys can qualify for it. And what is the requirements for it, right? So CMHC MLI was actually introduced in 2022 around March, and it replaced the CMHC MLI Flex program, right? This is just another mortgage loan insurance program where we can get insurance on our mortgage, right? But what's the benefit of this CMHC MLI, right? Obviously, Linda has discussed that this was required in order to achieve the affordable rentals, right? Government want us to build more and more houses, more and more affordable units. So this is the reason they have introduced one of these programs, MLI Select, which has caught everybody's attention in the recent months. But what does it offer? So it offers extended amortizations and low down payments. Extended amortization means usually we're getting 25 to 30 years of amortization. In MLS, like we can get up to 50 years of amortization. low down payments, we can, as long as we're getting qualified, the requirements are meeting the criteria, we can get a 95% loan to value. So basically, we're just putting 5% down. What kind of properties are eligible for hitting the CMHC criteria, right? So this program is suited for, they divide basically in a tier system, right? Tier 1, tier 2, and tier 3, where they will focus on energy efficiency housing, affordability, and accessible housing, right? So whatever the points you hit, you will get like basically amortization or down payments based on that criteria, right? You need to have minimum of 5 units together. It can be 5 units side by side, or it can be like one unit on top of each other, or a garden suite, or a basement. And as long as they are next to each other, you can get qualified in the CMHC program, right? The big eligibility criteria for this one is, now we know that buying commercial properties in anywhere in Canada, we have to put like 20 to 25% of down payment, and we don't even get like maximum of 25 to 30 years of amortization, right? The good thing about CMHC MLI is, though they focus on building residential properties, but as long as your gross floor area is less than 30% for commercial, you are allowed to have commercial units as well, right? Definitely, your down payment will increase from 5% to 7%, so you'll get like 93% loan to value, but you can add commercial properties as well. The fourth criteria is debt coverage ratio. Any property that CMHC is basically looking in the DSCR is their biggest criteria to get you qualified, right? They want to see, okay, your properties are cash flowing. What does that mean is, they don't want to see a property that's cash flowing more than what they want is like 1.5 or 1.6 DCR. They want to see a cash flow of like a good return. 1.1 is the minimum cash flow return that they want to see, which means on every $100 that you're spending, you're making $110. So this is how CMHC has divided affordability, energy efficiency, and accessibility based on the point system. You can get qualification on CMHC based on 50 points, but we are just focused on 100 points. All our developers, builders, and whatever the lending will be giving you, it will be based on the 100 points in affordability criteria. What does that mean? That means that we have to give 25% of our units, whatever we are buying, for an affordability price, which is 1665 in Edmonton and whatever is a different city, right? So if you're buying 8 units, you have to give 2 units on affordability criteria, right? This is what they want to look into the rent levels. Energy efficiency, energy efficiency is obviously the course which they want to see, okay, you're building the properties based on the energy efficiency. It's not like our builders, whatever we are building, are pre-construction houses, right? So we don't have to literally focus on what energy efficiency is, because all these developers will be building the properties based on the energy efficiency code, right? We only have to look into these points if we are renovating an old building and putting everything as a new system, right? Then we look into what these energy efficiency codes we have to put. For our case, we don't have to worry about it, right? Accessibility, we have to give some units an accessibility. Accessibility means for any emergency case or anything, it's accessible, right? If an emergency vehicle or an ambulance or anything that you want to access, it's legally allowed, right? That is what accessibility. This is all three things: affordability, energy efficiency, and accessibility. What CMHC wants us to put in the properties, and then if we qualify on 100 points, they will give you the best amortization, and they will give you the best rate of interest, right? So again, you can see, if you hit 100 base points, you can get up to 95% of loan to value, 50 years of amortization. You can still get CMHC on 50 points, 70 points, but you won't get the best benefits of what CMHC MLI Select program is going to offer. Also, one thing I want to tell you is that CMHC has no restriction on what kind of affordability housing that we have to provide. It can be either a bachelor suite, it's a studio apartment, 1 or 2 bedroom, right? As long as it's a legal dwelling, it's considered as an affordable rental housing, right? So once we hit the level 3, which is we're going to consider 100 points, right? Once we hit the level 3, because most of our builders will be working on, every builder, will be working on 100 base points, we have to give 25% of it as an affordable units. What is going to happen is limited recourse. That is the biggest advantage that you're going to get. Is the personal guarantees will be very limited. If we're hitting 70 or 50 points, the personal guarantees increases. But in our case, when we hit 100 points, right, limited recourse, personal guarantees are very minimum or eliminated in some circumstances, right? If you will get the best interest rates. Interest rates right now, we're getting files approved at 3.7 to 3.8% for 50 years of amortization. Better loan to value, obviously, I've explained, you can get 50 years amortization, but you got to understand, CMHC only wants to put money in a project which is cash flowing and which they see it makes sense to them, because these guys will be putting 95% of their own money, right, of the lender's money. They'll be insuring it. So they want to make sure their property is meeting the 100 base points, and they can give you the best interest rates and better loan to value ratios.
Meet, I just have the question about the last slide. So basically, if you get 100 points, you don't have to be personally liable for anything.
No, so it is limited personal guarantees, right? You still have to put any, even if you're just a silent partner in a as a director or whatever it is, that you're not showing your net worth, you're just putting a down payment, just helping it. You still have to do personal guarantees, right? But that course is very limited, man. You know what I mean? They won't come after you for the entirely property of yours, right? They will just, it will be like what a limit, maybe 20 to 25% of the personal guarantees. That is the thing. Once you get 100 base points, you will have to put a personal guarantee. But if they want to come after you, whatever is the case is, they will not like probably take the entire property from you.
Okay.
Okay. Borrower requirements. This is what CMHC wants for us to get qualified. This is what we need. Your clients need to get qualified. Definitely, you need to make some of the personal of the monthly incomes or annual income. You're putting the CM, filing the taxes. Everything is good, but they don't focus on the personal income entirely or your credit score. They focused on 25% of your loan value. So if you're buying a property worth $1 million, for example, right? You need to have 25% net worth of it. So you need to have $250,000 worth of net worth. That net worth can either be your cash in bank. That net worth can either be your equity in the house or RRSPs, anything, right? But it has to be a net worth. Only this is possible only if you're hitting 100 base points, and net worth is more. They will consider your net worth more than credit score. Credit score minimum, which we are getting to know from the lender, is which they want to see is around 625 to 630, which obviously everybody should have it, right? If they're planning to buy CMHC, but they're not entirely focused on your personal income and credit scores. Liquidity, you need to have some sort out of your 25% down payment of your net worth. You need to have at least 10% of liquidity assets. That assets mean that you can easily convert into cash if it's required, right? The CMHC wants to see if you're not just putting 5% down for any reason, you need to bring up more extra cash. You have that extra fund sitting in your liquid, right? That you can easily liquidate and bring out the 10% down payment, right? That is just, it's not like you need to put it, but you just need to show it. Okay.
So that's like a deposit plus 10% or
no? So it is part of your it's part of your net worth. So if you're putting 25, if you're showing 25% of your net worth, right, you need to have at least 10% of that net worth as a liquidity. Okay. Other thing is CMHC wants us to have is a rental managing property experience, right? They need to make sure that you guys know how to manage a property, which means that you need to have at least 5 years plus of rental experience. That rental experience does not mean renting your basements or anything in your own house. It means you're renting your entire properties, which a lot of us won't have it, though we have like 1 or 2 rental properties, but we are not entirely managing it, right? For that thing, they also allow us to have a third-party rental management contract. So it doesn't, if you don't have the 5+ years of managing similar properties, it's okay to have a management company contract in place that can take care of your properties, right? Because you can understand, CMHC is putting they're giving you insurance of 95% of the loan value, right? They want to make sure that you guys know that you guys can take care of the property. Okay, they just want to be like, okay, I'm just managing the property by myself. They don't want to do that stuff. And the good thing is, we have in-house developers from our own builders that can actually do it for you. So you don't have to go outside, start searching for a rental property management company and start bargaining on your price. Whatever they're going to do is, whatever you're going to be buying with Baker, we have in-house rental management companies with the builders. It's not us. With the builders that will manage a property. They're already managing more than 400 to 500 doors. So they know how to take care of their own properties. So what benefits do we get in CMHC? Obviously, now we know what is the criteria, how do we get qualified and all this stuff, right? But what benefits do we get once we apply for a CMHC loan? Lowest interest rate, which I already told you, we're getting approvals at 3.7 to 3.85%, which is way lower than what traditional conventional mortgage we get, right? It's based on the bond rates, and we get lowest insurance premiums as well. Usually our insurance premiums are 4%. In a conventional mortgage, when you're putting 5 or 10% down payment in a regular property, you have to put 4% as an insurance premium. Whereas in CMHC MLI Select, you only have to put 2.8%, which is fixed. Whatever is the insurance premium going on right now is just 2.8%. Second thing is, you will get a term year of 5 to 10 years. You can get a 3-year term, but we don't recommend, or the lenders won't recommend you to get a 3-year term, right? We tell everybody if they want to keep the property for a long time, because this is a generational wealth, right? It's not like buying and flipping the properties. Get at least a 10 years of term, right? So that way you are building, because see, CMHC is only going to fund you the project if it's generating cash flow, right? So if your property is already generating cash flow, why not to get a 10-year term? So even if the rules changes or whatever does, it's not going to affect your cash flow, right? So this is going to be a long, stable cash flow, positive cash flows thing when you get a 10-year term. Loan amortization, I've already discussed. 50 years of amortization. Usually if it's 25 to 30 years, you imagine when the CMHC increased our amortization from 25 to 30 years, our mortgage payments decreased by the good amount, right? Now here, you're getting an amortization of 50 years. That does not mean that there's a certain limit of the price range. Any file that's gonna get with 100 basis points approved is gonna get a 50 years amortization. Means even if your file is $2 million, it's still gonna get 50 years amortization. If it's $50 million, still the same amortization, right? Once you hit the 100 basis points, you can get up to 95% of the loan to value, and it's all based on the new construction houses, right? That means you're putting only 5% down payment, getting 50 years of amortization, your 10 years of cash flow, and the lowest interest rate and the insurance premium, right? This is all the benefits that you get when you qualify for a CMHC mortgage. This is just to show you what $150,000 can actually buy in terms of the price range, right? When we're buying a traditional financing, this is just simple math. You can see, like, in this, I'm not even including any lavish development charges or closing costs. It's just like $150,000 flat with 20% down as a rental property, right? I'm not saying first or second rental property. You can only buy up to 750 years of, 750,000 worth of property, right? At that time, you'll also get capped because how much properties you can buy, right? You can put like 6, 7, 8 properties at that time, and then that's it. Like the lender's gonna stop approving you, right? Whereas in CMHC Select, you put the same amount of down payment, 5%, $150,000, which is only 5%. You can get $3 million worth of property. That $3 million worth of property can be either 10 townhomes, 15 townhomes, or rental apartment buildings, or even like detached homes, which is kind of in a question right now. But everything, whatever you're gonna buy right now, you can get at 5% down. Second thing is there is no cap in CMHC. So if your net worth is strong, if you have good net worth, CMHC is not going to stop you in buying 3 or 4, 5, 6 properties. You can buy as much as you can. And good thing is it doesn't show on your credit bureau, right? So if you have 20 or 30 doors, 100 doors, right, it's not going to affect your ability to buy your own or change your own prime residences, right? You can still buy your own residences. It's not going to affect anything in that. So what benefits do you guys get when you're buying with us, right, with Baker? Obviously, we've been discussing a lot of stuff with the builders. That's why it took us a lot of time, right? So we have counted a lot of incentives which nobody can match, right? It's going to be very tough for you to even just present it to any random builder and tell them to match it. They won't do it, right? The good stuff is 5 appliances for the house, and if there is any basement apartments, 4 appliances, right? So basically, every dwelling will get their own appliances. Okay, complimentary environmental report. So if you're buying a 50 or 60, 70, 20 million project, right? That will include environmental report, which can start from $500 all the way up to $7,500, right? This is given to you as a free of cost. So you don't have to worry about paying any extra, even these are small fees, but it will start to count more and more, right? Zero broker fees. This is one of the best incentives in CMHC MLIs because you actually don't need to have a broker in the house, right? You can file directly with the lender. You can file directly with the builder. You can tell the builder to file it for yourself. So you don't need a broker. But 99% of the client will tell you to go for a mortgage broker because it's actually easier for everybody. They're going to collect your file. They're going to do everything. They will charge 2% fees, right? So for brokers, if you go outside, you can call your own brokers. You can see they can charge 2% up to 2% fees. For bigger projects, maybe 1.5% fees, right? With us, we're going to be doing everything from your side, but we're not charging any fees though. Okay. The only thing that you guys have to worry about is just working with in-house builders mortgage. Okay. Complimentary appraisal. This is also one of the big advantages working with us is that we will provide you an appraisal free of cost so that we will not have to worry about what if my price is higher or lower, what my property is valued at, right? We'll give you an appraisal report free of cost, and you can also do an appraisal before closing. So if at that time your appraisal is a little high, you can do another refinance or whatever. It will be given a complimentary from our side, right? And this whole project that you're buying is covered under new home warranty. So Sunil and Ajay, you guys have been working in Edmonton, all of you brokers, you know new home warranty is the same as a 10-year warranty in Ontario, right? So your entire property, even if it's a 50 million, even if it's a 2 million, it comes under new home warranty. So everything from top to scratch is under warranty.
And like that's also like covered for 10 years instead of 7 years in like Ontario, right?
Yes.
Warranty program. Yeah.
In-house property management fees, right? So whenever I don't know if you guys have ever worked with a property management company in Edmonton or Alberta. Usually for these kind of small properties, they will charge up to 8 to 10%, right? And it's very difficult to get a hold of them, right? Even for a small thing, you have to call them and they will take their own sweet time. But the amount they are charging you is insane, right? What we have done is because we have an in-house property management from the builder, we are giving you as an additional incentive at only CMHC recommended rate. CMHC recommended rate is 4.25% of management fees plus 2% salaries or $500 salaries. This is their CMHC's benchmark rate. So, and this is the rate that we'll be actually charging you guys for the property management. So you guys don't have to worry about finding a third property rental management outside. Outsourcing is and then trying to negotiate on the price, right? Whatever CMHC wants us to put in the pro forma, same price we guys are giving it. Okay.
Meet, I have a question. How long is this rental guarantee in property management for?
You're paying for it. So whatever, for how long you keep the property, you're paying for it, right? That's what I'm saying. So property management companies, they will charge 8 to 10%, right, of your yearly gross. Here, we're only charging you 4.25% plus 2% salaries, right? Management fees plus salaries. You can keep it for as long as you want because you need to have it in order to get qualified with CMHC, because they need to make sure that you need to have a 5 years plus of rental experience. So the moment you stop it, the moment you're going to decline your file with CMHC, right? You need to have it. Okay. Draw construction mortgage. The interest, I don't know if you guys have ever worked with a draw construction mortgage. It's same like a construction mortgage when we're building a custom homes, right? You get approved in 3 to 4, 5 months, and then there is a draw mortgage, first draw, right? Who's liable to pay for the interest for them? Buyer, because it's under the buyer's name, right? Because buyer is the one who's basically paying. If it takes 2 years to build a 50 million project, right? We have to pay for the buyers have to pay every month their interest. In our case, you don't have to worry about a single penny. Any interest payment, even it's $500 or even if it's $50,000, the builders will be covering from us. So from your side, from your client side, it's just like a regular mortgage, right? Even if it gets approved as a draw mortgage, you guys don't have to worry about anything. But extra checks that we have done for you, because we're going to be providing you numbers per formas, right? Those numbers per formas are not done by me, Linda, Baker, or anybody else, right? Those have been, the numbers have been done in the appraisal report. The appraisal report that we guys providing you, and that appraisal report will have all the numbers of the rentals, all the rentals of whatever the comparison is going on and that performance, right? Second check is the lender performance. So the lenders himself will be checking on the performance and be giving us the numbers. So those numbers that you will actually see in the performance have been provided to us by the lenders, because they are the ones who are going to be actually approving your files, right? So they've already done their part. They've already given you a number. Okay, this is what we're going to be approving you at. Independent third party underwriter. Obviously, the lenders can make the perform, but there can be some corrections in the. There can be some errors in the numbers, right? It has been taken care by CPA. It has been signed by CPA. They have considered every number, so the numbers match whatever the numbers their lenders are giving. The fourth and the last is obviously whenever you're going to get a final COI approved, there will be again the same numbers that you guys have been checking. So there'll be different 4 checks on the rentals, on the comparisons, on every single thing that you guys need to look. It's not like we making our own numbers and giving it to you guys. Again, some exclusive incentives which nobody can match. It's going to be very tough for everybody to match. A few of them, no cost appraisals. Appraisals are provided free of cost. So it's not like you guys have to pay for appraisal. You know, we have to pay for appraisal, and that cost sometimes is $700 or go up all the way up to $3,000, right? But when you're doing some commercial appraisals from JLL and Canada ICI, which most will be your appraisals for the big projects, they can even go up to $13,000, right? So you guys don't have to worry about anything. We'll be paying on appraisal from your side. Price match guarantee is one of the big incentives that you guys will be providing. So for any reason, and it doesn't mean that if your appraisal is higher, you're going to increase the price. No, if your price is lower than the appraisal value, right, we're going to match the number. So it doesn't mean that you are putting 5% for the base value and then the extra gap you have to put down, right? No, whatever is the appraisal value will match your price. Turnkey delivery. This is one of the biggest incentives that literally your clients will be thankful for you guys, right, to giving this kind of incentive. This is a turnkey delivery, and this turnkey delivery does not mean that we're gonna be just giving you closing costs and giving your rental management company and then they'll be taking care of you. So no, this turnkey delivery means once your COI has been approved, whatever it's like, whatever has been your house has been closed, right? We'll be renting the property. Builders will be renting the property from your side. They will be taking care of the mortgage payments. They will be taking care of the property taxes. They will be taking care of every single cost that is associated with your building until it's fully leased. So that means if you are buying a 8-door unit, right? CMHC benchmark is to lease 97% unit, right? That is, they call a sustainable rental. So once you hit a sustainable rental, only then you guys will be start paying for your project. So that means your client will be getting the keys of the project once it's fully leased out, even if it's 100 doors, even if it's 300 doors. So example, if somebody is buying 100 doors, right? It might take probably 3 months, 4 months, 5 months to rent out the entire building, right? Who's paying for it? We guys are paying for it, right? The buyers are paying for it. They are paying for the vacancy rate if it's not rented out. In this case, you guys don't have to worry about it. Builders will actually start renting it out the moment, even like way before the house has been closed, like because now they know what date will be the closing date, right? So they can start creating the rental applications. They will rent out the property for you, even if it's 100 doors, and you will be only starting to pay the rent when it's leased out. So for us, it start gonna pay money, right?
Got you.
And just to add to that, I think we touched on it, but just to reiterate again, in any traditional situation, if there was a holdback by the lender and the developer wasn't getting that remaining 15%, you as a purchaser would generally have to pay them, right? You still have to pay the builder because they're delivering the product. Here, our builder has pretty much said, okay, is your incentive, we're not going to make you accountable for that 15%. We're going to wait for it. Once it's released, because we've hit your stabilization numbers, that's when they get it. So that's a huge, huge benefit, because any normal situation, you'd be paying for that first, another 15% on top of your down payment to get your property, right? So this is why we work with a builder it's more so like a partnership. Their goal, you all have the same goal, to try to get the property tenanted out as fast as possible and to get the holdback released and everybody's happy, right?
And like how long client has to keep it before they can sell it to someone else, minimum?
So honestly, this CMHC MLI project that you'll be buying it, right? It's not recommended for flipping clients, to be very honest, right? That somebody just want to flip and take out the money, because this is actually done. The good thing about this project is you can reappraise and keep buying more and more, right? Like you'll probably have like $0 down in the property, but you'll have 100 doors, right? But again, for any reason, if somebody still wants to do an exit policy, right, they have to sell this as a CMHC.
Okay.
That's the thing. People that generally buy these properties, as Meet said, it's a hold, right? It's generational wealth over many years. I know some people that have refinanced the property 5 times over. You're getting all of your investment back, and you're still gaining all the cash flow benefits, right? So why would you sell a property like this? Yeah.